Hello again, everyone. This is Gene Ahrensberg coming to you from our HQ in beautiful but pretty saturated Southeast Texas near Houston on Sunday, September 30th, 2012. And as everyone knows, we're heading into that bizarre quadrannual period in the United States where we see the most unusual migration of political animals as both conservatives and liberals migrate toward the middle to attract the so-called undecided voter. We liked what Dick Morris, the former political consultant and frequent guest on TV, said about the undecided. He said that when somebody says that they're undecided, it means that they've already decided not to vote for the incumbent. It's like answering the question, will you still be married to the same person 4 years from now? If someone is undecided on that question, then there's trouble ahead for the incumbent's spouse. So Mr. Morris says that means the undecided usually break for the challenger. I guess we'll see soon enough. As expected, both gold and silver have had good runs since our last video 1 month ago, mostly on the perception that massive money printing by the world's central banks is good for commodities and equities. But the effects of global QE may be taking a pause now, to let the market rebalance just ahead. And what a difference a month makes in the CFTC Commitments of Traders reports, as we'll get into in just a moment. Looking at the closing table for this week, gold closed the week about flat, and silver answered down 2 pennies, which is also about flat. However, gold in euro terms cut an all-time high this week, just under 1,380 euros, and finished just under that at 1,376.50. The miners, big and small, which have also been on a tear lately, also paused, pulling back from 1 to 3%. Looking briefly at one of the subscriber gold charts, gold has run into more determined opposition in the area shown in yellow, which is, call it $1,775 to $1,800. But it had gotten overbought on a short-term basis, and as we will see in a moment, it's also run into quite a bit more opposition from the big sellers of gold futures. Notice that on Wednesday the trading moved to within a couple of dollars of triggering our trading stop. Be sure and check for updates this coming week, especially if we get some chaos on account of the CFTC position limits getting tossed by a federal judge. You'll find our coverage of that story on the blog, and it just might cause traders to shoot first and ask questions later, but our sense is that the effects, if any, will be very, very short-lived. At any rate, we have moved well beyond the giant flag formation on the global QE and massive money printing by the world's central banks, which, by the way, shows no sign of stopping anytime soon. We think that probably means that significant to strong dips should be bought, with appropriate trading stops, of course. While we're here, it's pretty easy to see why gold has run into resistance here, as expected. The previous 2 moves higher both ran out of steam in this same general area, so it's only natural that gold bears would dig in here and perhaps create a triple top to sell heavily into. They'd like to paint that picture so that the already large short positions have a chance to become profitable. They're underwater now. Longtime readers know that we hold a large measure of contempt for so-called triple tops. In our own, admittedly narrow technical view, triple tops are nothing more than failed double tops that fail to hold the trading in check a lot more than not. There are people who make a living on Wall Street betting against triple tops and triple bottoms, but I digress. However, the run is kind of extended, and sellers just might get a little downside action going now, but just remember that as gold moves to new highs now, each time it does, virtually all of the shorts in futures, in forwards, and in the OTC markets, and a giant world of derivatives we can't even track all over the world that have been put on since gold began this rally, are all underwater and vulnerable. Now, more to the point, what is the difference between those last 2 peaks and now? Well, first of all, in October and in February, the gold market was still in a downtrend. The focus was on Europe, and we hadn't heard from Dr. Bernanke yet. We hadn't heard his speech in Jackson Hole in late August, and we hadn't yet seen the Fed's decision to buy mortgage-backed securities and extend Twist and extend the time for zero interest rates to 2015. That was earlier this month. In October and February, we hadn't heard ECB President Mario, whatever it takes, Draghi tell the market that the ECB would do whatever it takes to preserve the euro within the ECB's mandate, whatever that means. We hadn't seen the ECB buying bonds or Japan pumping 126 billion US dollars into its economy, and so on. Let's zoom out a little to the 3-year weekly chart. And the point is what is different, friends and fellow vultures, and that is that the world central banks have decided to go all in with their Keynesian-esque overstimulation to their respective economies. That translates into a simple theory for us. We call it the race to debase fiat currencies. It's nothing new. It used to be called a beggar thy neighbor policy, where central banks and governments are all diluting their fiat currencies, and that means even more monetary inflation that will show up in the system. We're going to let others cover the details, but when it comes to the money printing, we have hit the all-time big time, as we say here in the South. The central bankers are going all in. They have to at this point, lest their monetary command and control theories be proven wrong. And while they are, it's best not to try and argue with them. Now, having spent too much time on gold, let's jump past the silver chart for now and just take a quick peek at some of the indicators we don't look at all that often in these videos, for context more than anything else. We're going to hit the highlights and keep moving because we want to focus on the commitment of traders reports at the end of this video today. Oh, before we move on, if gold manages to get past that resistance area shown in yellow, roughly $1,775 to call it $1,810, if it does get past that, for whatever reason, it could go vertical and it could go higher quickly on massive short covering, as so many short positions will be underwater. Watch for it. Now first, notice that the Spider Gold Trust, or GLD, briefly touched a new record high for its holdings of gold metal this past week, near 1,330 tons of gold, before dropping back to about 1,320 tons on Friday, September 28th. Like other ETFs, when GLD metal holdings are rising, it means that there's been more buying pressure than selling pressure, and vice versa. Now, it's no secret that we have come to view changes in metal holdings in the ETFs as more of a contrary indicator than anything. So we're really glad to share this next chart, the metal holdings for iShares Silver Trust, or SLV. And there it is. And the reason we're glad to share this one is simple. It is nowhere near its record highs for metal holdings, which tells us two things. First, the market has not been all one way with too much buying pressure, which suggests that we are likely not near the end of this new bull market for the metals. And second, it hints that there are likely legions of people that have missed this rally for silver and are waiting for a good pullback to buy in. With the elections just ahead in the U.S., they just might get that pullback too because of the uncertainty that goes along with it. But no one can see the future, and the best bull markets always make it difficult for people who miss them to catch a ride on the bull market express. Before we leave this graph, buying pressure would have to outstrip selling pressure for SLV to the tune of about 1,500 tons in order to get up to where it was near the peak when silver peaked near $49 in April of 2011. Next, we won't spend much time here, but this is the Dow Transports Index with the Dow itself shown in purple. This chart is screaming a warning for a short-term pullback for the big markets because this most recent rally has taken off without the transports. Now, that's not an absolute. It could be a false signal. They've happened before. But the way to bet, if this is the only data we have to view, is that the Dow will converge back with the transports lower. Let's move on. Next is the VXO Volatility Index, which has gotten lulled into what passes for complacency these days. And by the way, this is our preferred volatility index. Traders figure the Bernanke QE 3, 4, and 5, 6, 7, 8 put will bail them out no matter what. But our question is, what happens if Dr. Bernanke is all in this high-stakes game of economic hold'em? In other words, what happens when the next black swan descends in our economic frog pond and there's no more QE ammunition to fire? The risk there is that QE loses its magic right when we need stimulus in the worst way. It's unsettling to think of what we might face under such a scenario, isn't it? On a raw trader level, what the VXO is telling us right now is that insurance for portfolios is about as cheap as it has been in the last 2 years. The Fed has our back, says the big markets. Damn the torpedoes, happy days are here again, as we mix two non-metaphors with today's Fed firmly in mind. The Fed's got your back, Mr. Investor. Right. Now would be a darn good time to buy a little of that insurance, wouldn't it? Peace of mind for portfolios is on sale, and that usually means that the price of insurance is more likely to go higher than lower from here sooner or later, and more likely sooner. Moving on now to the positioning of the largest traders of futures in gold and silver. Let's take a brief look at the CFTC Commitments of Traders reports and see what's going on. Looking first at the Legacy COT report for gold for the combined commercial traders, which includes the producer merchants, the swap dealers, and perhaps some of the other reportable traders from time to time, we can see that as gold ran into more determined resistance in the 1770s and turned in the first Tuesday to Tuesday decline in 6 weeks, a dip of about $11 to $1,760. The traders, the CFTC classes as combined commercials, added another 12,722 contracts, or about 5.1% to their net short positioning, with the open interest up a roughly similar amount. Let's look at the graph for the large commercials. That 262,000 contract LC&S kind of jumps at you, doesn't it? Right off the bat, we see it has now eclipsed the previous turning high, and it isn't very far from the LC&S highs as gold was powering higher in August of 2011 on its way to the all-time nominal high of $1,923 last September a year ago. Now this is the fun part of what we get to do as COT wonks, because this indicator is at a very critical point. The LC&S is at the point where we could either see the big sellers win the day here with the price of gold retreating and the LC&S falling to answer, which is the usual case from these levels sooner or later, or we could also be at the point where the big sellers are forced to retreat as the price of gold runs on higher, which, by the way, is exactly what happened as gold zoomed another $260 higher from the LC&S peak in early August of 2011 as the combined commercial net short position fell nearly 60,000 contracts on the way to $1,923. So as we said in the subscriber graph, we have reached a time for caution. Understand that when we say that, we mean caution for bulls and bears alike. This is a very good reason we use trading stops rather than just guessing at market tops. Stops work if you let them and if you respect them. Moving to the relative commercial net short positioning, which compares the LC&S to the total open interest on the COMEX, what we call the LC&S-TO. We've obviously moved into the caution zone with a high 53.6% reading. That's very close to where the LC&S-TO peaked on August 2, 2011, with gold then $1,659 as shown on the graph, just before gold took off on its terminal surge toward the all-time high 5 weeks later. It is terribly interesting to us that as gold zoomed higher then, the LC&S-TO was plunging as the big sellers were forced to cover and buying pressure came in from both sides of the battlefield. Longs buying more longs and shorts covering. The big hedgers were closing their hedges, falling back, redeploying at higher levels all the way up to the peak then, until they finally found a level that would stick. It was beautiful, and it wasn't the first time either. Before we move on, here's the bottom line of the legacy COT for gold. The big hedgers have taken a big stand here at obvious resistance. They are apparently confident that gold will pull back now, and they might be right. But history tells us they can also be wrong. Big wrong, hugely wrong. So our attitude is, and has to be, that we adopt a near resistant strategy for our trading stops. That means that in the event gold catches another leg higher from here, which would almost certainly trigger a new round of buy stops and heavy short covering, we are on board for the run. But if the big sellers succeed in getting some downside traction, then our stops will get us to the relative safety of the sidelines, protecting a nicely profitable trade. Wow, time really flies when doing these videos, so we're going to have to pick up the pace. Apologies if we move too quickly, but our main point is already made. Let's take a look at just a few of the charts of trader positioning courtesy of the CFTC disaggregated COT report. It might be fun for those new to these charts to take a look at our previous videos to compare them to today. First, here's the graph for the traders the CFTC classes as producer, merchant, processor, and user, the big hedgers, including the largest dealers and the bullion banks. Remember that the big hedgers are always net short because they're hedging, so their positioning shows up as a negative number in these charts, and as the blue line rises, their net short positioning is going lower and vice versa. Remember that in the legacy COT report, the combined commercials showed a total of 262,000 contracts net short. One look shows that the producer merchants account for about 213,000 of them, and that is the largest commercial net short position for the big hedgers since June of 2010, when they had a net short position of 223,000 lots with $1,239 gold then. That time the large net short positioning worked for the big hedgers. Put the word worked in quotes. It worked a little and for a short while. Gold pulled back a little under $100 then before resuming its march higher. And notice that as gold pulled back in July, the big hedgers were covering, let's call it 75,000 of those hedges back then. One of these days we're going to do a 2-hour video so we can cover some of the nuances that develop in these charts. But not today, and not until after this bout with the mad stomach bug from Mexico is totally gone. Let's move on. Here is the chart for the traders the CFTC classes as swap dealers, the mercenary banks and firms that sell swaps in other markets and then hedge those derivatives using COMEX futures. This week the swap dealers actually reduced their collective net shorts by 7,931 contracts, but that's after the previous week where they increased them by a big 14,000 lots in 1 week. It wasn't all that long ago, in July, that the swap dealers reported a small net long position with gold then at $1,580. With gold now in the 1760s, they have ramped up their net short exposure to about 50,000 contracts, which, as you can see on the chart, is near their highest net short positioning of the year. Moving to the other side of the gold battlefield, the funds, the traders, the CFTC classes as managed money, have certainly put on a large number of net longs since they got down to that very low level of only 59,000 contracts net long in July. They've added close to 100,000 gold contracts net long since then to show about 156,000 contracts net long as of Tuesday, September 25th. Notice, however, that even so, the funds have not put on as many new net longs as they did in the last major turning high for gold, which was then in a downtrend, consolidating the all-time high. And notice that gold is very close to where it was then. And notice that The net long positioning now is well under the big peak as gold was closing in on its all-time high a year ago. What does all that mean? Well, in our simple way of looking at the COT, or in this case the DCOT, the disaggregated COT report, it simply means that gold is where it is today without the funds, the big buyers of paper gold futures, if you will, having expended all of the firepower that they have historically used in the past. This graph suggests that the funds still have ammunition to fire. It doesn't mean that the funds will expend that firepower. They might take a powder here. We just can't know in advance. We don't know what the headlines will be tomorrow. But have the funds used all their bullets? Nope, not by a long shot. And remember in the last few videos how we mentioned that the funds had gotten up to their largest pure short position for gold futures since the great 2008 panic, and how we said that a falling managed money short position was bullish for gold. You can look it up on YouTube, and please do. Well, look at the graph for managed money short positions now and how the gold prices have reacted. Bam! Just since July 24th, the funds have covered a big 23,978 or 72% of their short bets in 9 weeks, from about 33,000 to roughly 9,000 short contracts. Friends, that is about as clear a reversal of sentiment and positioning we could ask for. Spec funds have closed out their very high insurance short positions, which actually peaked back in late May at nearly 41,000 gold shorts, to now back inside their normal range. That's beautiful too, is it not? Before we move to the conclusion, let's just take a peek at the graph for the traders the CFTC classes as non-reportable, the smaller traders who are not required to report their positioning. Ooh, look at that. The little guys of the gold trading pit are within 60 contracts of their all-time high net long positioning, and that was set last reporting week at about 58,500 contracts net long. This chart by itself is the most bearish signal we have looked at today, and it is screaming to us that the smaller traders are probably vulnerable to a stop triggering rate very near term. Just remember though what we said about not being able to see the future and why we use trading stops instead of just trying to guess when a market has reached its ultimate pinnacle. We're getting close to running long, so the bottom line for the gold COT this week is that the indicators we rely on most are now firmly in the caution zone. The big sellers of paper gold futures have taken a meaningful, sizable stand at what must look to them as an important resistance level. Right or wrong, win or lose, we have shared our own trading stop strategy with Got Gold Report subscribers, and we have the luxury of allowing our near resistance stop strategy of more or less doing our trading for us. As mentioned in our trade notes this week, the funds have high net long positions but plenty of unused firepower. The big sellers have taken a big stand in opposition and have gotten to sort of the same point where they were driven into retreat in August of 2011, and the little guys are betting big on the long side and probably a little vulnerable. We're heading into the uncertain period ahead of the U.S. election with the QE spigots opened wide globally. There is trouble brewing in the Mideast. There are, as Rick Rule said recently, a flock of potential black swans circling, and who knows which one will attempt to land in our frog pond and when. Well, that, friends and fellow vultures, is why we use trading stops instead of just pulling the take profit voting lever at a random target. We'd rather take the ride as long as we can before jumping off to the safety of the sidelines. Up ahead lies the fiscal cliff here in the States, and we don't think that Eurogold made a new all-time high this week for no reason. At any rate, as always, mind your stops. We'll leave it there for now. Thanks for watching, and we'll see you all again next time. Bye for now.